Crypto assets are a relatively new type of asset that have become more prevalent in recent years, and there is a growing army of you investing in crypto assets with a view to making a gain. Because of its adolescence, the taxation of these crypto assets is often confusing and unclear. So in this video, we are going to cover what exactly is a crypto asset according to tax laws here in the UK, how cryptocurrency taxation works for individuals, how cryptocurrency taxation is determined for non-UK resident individuals, and finally, record keeping and reporting to HMRC. Before we get started, be sure to hit that subscribe button as well as the notification bell to make sure you're kept up to date with all of our latest content. This really helps us to produce more helpful videos and to get you free quality advice from real qualified accountants. According to HMRC, their official definition of cryptocurrency is crypto assets that are cryptographically secure digital representations of value or contractual rights that can be transferred, stored, or traded electronically. Furthermore, HMRC in the UK identify three types of crypto assets. Number one are exchange tokens, which are intended to be used as a form of payment. There is no one person, group or asset underpinning them at all. The value exists based on its use as a means of exchange or investment. Unlike utility or security tokens, they do not provide any rights or access to goods or services. Number two is utility tokens, which provide the holder with access to particular goods or services on a platform. A business or a group of businesses will normally issue the tokens and commit to accepting the tokens as a payment for the particular goods or services in question. And finally, number three are security tokens, which may provide the holder with particular interests in a business. For example, in the nature of debt due by the business or a share of profits in the business. In this video, we will be focusing on the rules for exchange tokens, which is the category that the popular cryptocurrency Bitcoin falls into and where most investors are at the moment. Cryptocurrencies tax rules for utility tokens and security tokens will use the same starting principles, but the final tax treatment may differ. It is also important to remember that this asset class is still in its adolescent stage, so the tax treatment is under constant review and can change very quickly. Before we continue with today's video, we're thrilled to be launching the Accounting and Tax Academy membership site early this year. We'll be posting downloadable resources, tax tutorials, and in-depth courses that you can't access anywhere else. And the best part is it's absolutely free to join. Head to the link in the description box below and register your interest today. If you are a private individual, then investing in cryptocurrency, it is highly likely that this will amount to an investment activity, and any profits you make will be taxed as a capital gain, which currently has preferable rates in comparison to income tax rules here in the UK. We've already produced a video covering capital gains tax, which we'll leave a link in the description box below. HMRC also recognise that there will be rare circumstances where an individual may be trading cryptocurrencies as a business. In other words, as a trading activity rather than an investment activity. But we must point out that this would be very rare indeed. In these circumstances, HMRC would actually tax you under income tax rules. Whenever you dispose of cryptocurrency, it could give rise to a capital gain or it could generate a loss. A disposal is defined as follows: either selling the cryptocurrency for money, exchanging one cryptocurrency for another type, using crypto assets to pay for goods or services, and finally giving away cryptocurrency to another person who isn't your spouse or civil partner. Certain allowable costs may be deducted from proceeds before coming to a taxable capital gain or a capital loss that can be utilised in the future. In addition, when it comes to the buying and selling of crypto assets, HMRC have stated that the Section 104 pooling rules will apply. So let's visualize this with a simplified example. Bob purchased 10 Bitcoins for £10,000 on the 1st of January, and this has been categorized into Pool A. Bob then purchased a further 10 Bitcoins for £15,000 on the 1st of July, which once again, because the asset class is the same, has been categorized in Pool A. Across both purchases, Bob accumulated allowable costs of £5,000. Bob then disposes of 10 Bitcoins on the 31st of December for £100,000. His simplified tax calculation will look something like this. Bob has now received £100,000 in sale proceeds for the assets, but that's not all profit and thus not all subject to capital gains tax. Since Bob has disposed of 50% of his holdings, he can subtract £2,500, which is 50% of the allowable costs we mentioned earlier. This is in line with the pooling principles we also mentioned earlier. We can also subtract the original purchase costs from the total. Now he spent a total of £25,000 on Bitcoin and is selling 50% of that, which makes the purchase cost allowable in this calculation of £12,500. Once we subtract this, we're left with a total capital gain of £85,000. However, Bob also has his capital gains tax allowance, currently £12,300 in the 20 to 21 tax year. This gives Bob a total taxable capital gain from the sale of his Bitcoin of £72,700. The capital gains tax Bob will actually pay will be from 10% up to 20% in line with 2020-21 tax thresholds. Now, cryptocurrency tax rules will also depend on your residency status for tax purposes. If you are a UK tax resident, then you will be subject to UK capital gains tax or, in rare circumstances, income tax on any gains or income that you make on your cryptocurrencies. If you are a non-UK tax resident in a tax year, then generally speaking, you will not be subject to UK capital gains tax or income tax on any gains or income you make on your cryptocurrencies. However, there are exceptions to this rule. As cryptocurrencies are intangible assets, in other words, they don't have a physical form, HMRC are currently adopting an approach of taxing based on you, the individual's residency, rather than the location of an asset, which is difficult to determine for cryptocurrencies. So this is particularly important for two key reasons. Number one, UK tax residents cannot shield their cryptocurrencies from UK tax by holding the crypto wallets in another country. And number two, non-UK residents will not be subject to UK tax on cryptocurrency transactions just because their crypto wallet is actually based in the UK. This is actually a complex area of tax law and planning and is continually evolving, so we always advise you seek professional help for your specific circumstances. Finally, it's worth noting that if you hold or gift crypto assets as part of an inheritance, then they will be classified as property for the purposes of inheritance tax. It is your responsibility as an individual to maintain sufficient accounting records to support your cryptocurrency transactions in accordance with cryptocurrency tax rules here in the UK. So your records should include the type of crypto asset, the date of the transaction, if they were bought or sold, the number of units, the value of the transaction in pounds sterling, cumulative total of investment units held, bank statements and wallet addresses if needed for an inquiry or review, details of exchange rate used to convert back to pound sterling. Any gains or losses from cryptocurrencies will be reported on your self-assessment return, and you will need to maintain these records for at least 5 years following the 31st of January submission deadline. It is also important to remember that although some cryptocurrency platforms and exchanges will maintain records, they may not maintain those records for a sufficient duration of time, and the ultimate responsibility lies with you, the individual, to comply with cryptocurrency tax rules on record keeping. As an individual investor, you will usually report any gain arising from your cryptocurrency investing or trading via a self-assessment tax return by completing the capital gains tax section along with any sections relevant to other sources of income. Even in the rare circumstance that HMRC consider your cryptocurrency activity to be a trade, you would still report via the self-assessment return, but would complete the self-employment section instead. We've already done a helpful video on self-assessment returns, so click on the card above to learn more about completing and filing one of these.